Hey, what's up, everyone? We're up to another episode of the wonderful More Than a Mortgage, and I am pleased to say that, gosh, it's been a year, Tom.
A year? Happy birthday. Happy anniversary.
A year since we started the show, and and honestly, I can say that it's been a fun first 12 months that we've done this, and
it's been exciting.
Not because I'm sitting here next to you, but because we get to look at this handsome videographer behind us all day long, smiling from ear to ear.
Thumbs up and
thumbs up to Jesus for making the first year a success, but
enjoyable.
We appreciate everyone joining us today on More Than a Mortgage, and so I'm Mike Black, and
I'm Tom Merritt.
And I definitely am living up to my name right now.
You are. That's right.
Got back from a family vacation in Florida with the family, and I think they're all a little upset with me right now because the sunscreen was at a minimum, and
forgot to pack it, eh?
Forgot to pack the long sleeve shirts, and I was fishing a lot, so if I look a little funny today, you know why. So
it's all good. It's a good base to start this summer.
It's good base and lots of peeling. So, but we're excited to talk about our episode today, and it's one that I think people don't talk about enough. I think the misconception in our industry is that there's we're dealing with a lot of it's just conventional loans, FHA loans, and VA loans. I think that's what people hear and think, and that's the mindset of a buyer going into all this is like, what type of loan am I going to do? Is it those three options? But the reality of it is, and I'll let you speak a little bit about this, is that there is a plethora of options for people out there these days. And I don't want to say it's getting back to 2007, 2008, 2009, and a lot of these options that we're going to talk about today that I think can help a lot of people achieve home ownership are scrutinized a little bit heavier, bigger down payments, better credit scores. Like, it's not, like the Wild Wild West where you just had a pulse and a credit score and you could get a loan. But we're going to talk a little bit about the non-QM loans today and how it's helping our clients just, in all sorts of different facets of the lending world and buying real estate, how it's helping them achieve that home ownership goal. So
absolutely. I think one of to your point, the misnomers is that, 30-year fixed is the only loan. And again, you made mention with the conventional or FHA, and, the market, it's no surprise, has slowed way down since 2022. Back when interest rates were, what were they, like -%? People were getting paid to take mortgages.
Yeah.
But one of the ways to kind of kickstart it a little bit is offering some of these. And, they did that back in, 2004, 5, all the way through. And it did lead to kind of some issues in 7 and 8. But in some of these loans, just a different approach to it and taking a little bit more of a commercial view of it. And it's really crazy to see the growth, 6 months ago, based on some of the stats that I've found, 1 in 100 loans were done with these non-QM, and in just 6 months ago. 6 months ago.
Okay, 1 in 100.
1 in 100, and now in 6 months' time, it's now 4 out of 25. So basically, long and the short, that's increased to almost 16% of all the loans done are non-QM. And again, I think it was another stat that people don't necessarily know is 2025 saw the fewest number of loans done since 1995. So fewest number of loans in 30 years. So they needed to get a jump start. These are the ways that you're going to get the markets going again. And I think that's why these banks, Congress and things are starting to allow these, because something needs to jumpstart the market. And so today I'm super excited as well, because we've got, just to highlight, probably good six different options that are out there that, 4 years ago, if people came with these types of situations, they would say, I can't do anything.
Yeah.
They didn't fit in the proverbial box.
And we'll hit on that too, because I think that's one of the other things that is a discouragement in our industry is that, a lot of people they're going to their bank, right? They're applying for a mortgage. The bank comes back and says you don't qualify, and then it puts them in a mindset that they can't do this.
100%.
And so that's kind of why we wanted to get this out there today, is so that you buyers and clients that we work with and real estate agents out there know that there are options. And just because you're told no doesn't mean that you're done. It means that, you need to explore your options with, lenders out there that have alternative financing products.
Generally speaking, you had to have 3 facets. You had to have your willingness or your credit. you needed to have your income, and you needed to have the cash for the down payment. And those are the three big things. I think it's translated today. If you have two of those three, there are probably options for you.
Yeah.
And so, again,
if you have one of those three, we have options for
potentially, yes, depending on which one of those three it is.
Exactly.
But,
it can't just be credit.
But a lot of the big box banks are still operating within the model of, does it fit in the box with the cash, the credit, and the income?
Yeah.
And that is almost old school, especially for self-employed borrowers, for investors, even doctors and some of these other professions. And so I think it's great to shine a light on some of these different things that are out there, because if you've heard no, definitely look into it a little bit further, especially if it was from a big institution, because there are a lot of different types of loan products out there that could make sense for you.
So realtors, you heard that. If your clients come to you and say, hey, I can't get a mortgage, I need to, my lender told me that I don't qualify, don't take no for an answer on that first round. Explore your options. Tell them to call someone that you trust and that you know knows these types of loans. By the way, it does take a loan officer that understands how to navigate through these loans too. That's going to be a key component to what we're going to talk about today, but you got to know what you're doing.
And just to be clear, these loans aren't like at 12% or anything.
No.
Close to market rates.
They're competitive. So let's start off with one that we're doing a lot of right now. And I think, if you back up to when I got into the business in 2003 and you got in the business around that time as well, I think one of the biggest loans that were out there for a self-employed borrower was a stated income loan.
Yeah.
And that used to be a loan where you state your income on the application and we, the lender, believed you.
As long as you had a certain down payment and or a certain credit score.
You just stated it. You said, I made $20,000 a month. And okay, great. You qualify. That doesn't exist anymore. So we did bring back a form, not a form of stated, but a form of self-employment verification, because we all know self-employed borrowers, they like to write off a lot, which justifiably so. They run a business, so they have expenses and things that they write off in their income. And on any conventional loan out there, you're going to be dealing with a scenario where whatever you report to the IRS is what your income is. We actually are doing a lot of bank statement loans. They're great. And we all have stories and successes that we've run on them. But basically what a bank statement loan looks at is the cash flow going in and out of your bank account for the last 12 or 24 months. There's a couple different options you can do. Most commonly, we're doing a 12-month look on that stuff. But we're looking at money coming in versus money going out, and whatever that nets out is what we're giving you as far as an average income over the 12 months. And that's, I'm sure you've had some good success with that, but gosh, how many self-employed borrowers would love not to have all their expenses counted into the picture and their write-offs in play when it's just looking at what your bank statement's performed at? And it could be on a personal or business bank statement.
Yeah. Now the key there is it's going to be one or the other.
One or the other.
So I would, in theory, set up a separate bank account, or hopefully you have a separate bank account for your business. But yeah, it's just getting the last 12-month statements, and they're going to compute based off of the cash flows coming in what the income is.
Yeah.
And it creates a lot of opportunities for a lot of those self-employed borrowers, or, we see some of the other ones, whether it be like Uber or Lyft, or maybe somebody that does a lot of an online type business where they're selling merchandise and things of that nature, where they've got a lot of deposits coming in. It's just a great opportunity or great option so that you don't necessarily have to take the tax returns, which again, you're incentivized to take as many deductions as possible to avoid taxes.
So on that loan, guys, we don't even need to look at your tax returns at all. It's just last 12 months of your bank statements. We actually have, cool part is when you submit that, and at least cross country where we're at, they actually have a department that goes through all that for you. So they'll come back and lay that out on an income sheet for us and say, boom, here's your income figure. So, and the nice part about it for any realtors out there with a client like this is that we're not just taking a stab in the dark and guessing. We're getting you a fully underwritten loan in hand to where you can say confidently, my client qualifies. My client qualifies with this income. We know we've been through underwriting already, and client feels good, the buyer feels good, the realtor feels good. We all feel good because we've already crossed our T's and dotted our I's.
Yeah, and I think taking it one step further, which is really cool, is, if in the event, say, you have commingled personal and business and you don't have that, but you're a 1099, or you've got, again, these self-employed borrowers, programs could utilize those as well, which would then enable you similar to, and again, the whole point would be to get pre-approved, to sit down, to talk through it. And, one of the things we were talking earlier that we didn't mention that I think is really big, and you made a great point, is that most banks, and I'd say a lot of loan officers, try and make sure the borrower fits to the loan that they're looking for, and to want to make sure that they fit in the guideline for the conventional, the FHA or the USDA. I think, again, more of the consultative approach that we've learned and have brought up, especially this day and age, it's not what does the loan fit the person, it's more what does the person and what do they need. So looking at their situation.
So look at it as more of a customized setup. Like,
absolutely.
Not do I fit the box perfectly for the bank's cookie cutter like guidelines. It's, what are the best options for me? And like Tom said earlier, guys, like these are loans that are real. I mean, you're probably talking about maybe a 0.5 point higher than what you would get if you provided all your documents, 0.5% higher. So it's not like you're paying the 12%. If today's rate's a 6.75, you're maybe at 7.25, and it's a very competitive setup for someone that doesn't have to provide their bank or their tax returns to approve all that. Let's hop into another one. So I think long and the short on that, self-employed buyers, don't feel rejected just because you get rejected by something. Do a little homework on the side and see what you...
Especially it's as a result of the income.
Yeah, exactly. Another one that we're doing a lot of right now, and I think this has been a great option for my investors.
You like this one?
Yeah, it's our white label here is our investor cash flow loan, and it's great because in the past, when I compare it to what we used to do in the past, if I had an investor that wanted to buy a 3-unit building, for example, and he or she owned say 15 other properties. In the past, we would have to verify all the debt on every one of those properties. I mean, by the time you got done verifying everything from that investor, it was like a stack of papers almost to the ceiling, and investors got frustrated by it.
Especially if in the event they had done some capital improvements or had, again, write-offs and things of that
losses
nature
on their properties. Yeah. Today we have this really cool loan that we're using for our investors, and we don't want to see anything. We're only underwriting the subject property, which means that I don't need all the mortgage statements from your 15 other properties. It also means that I don't really care about your income. I just care about whether that property cash flows the right way. And so, essentially what we're looking at on that is, do you have the right credit score? Do you have the right assets to perform for the closing, for down payment and closing costs? And then does the property perform? Does the property produce, have a good cash flow income, net income when we take our calculations on it?
And what's that based off of?
So let's say your rent's $1,000, your mortgage payment's $1,000, you qualify.
Yeah.
So as long as it
covers it,
the rent covers the mortgage. In most cases, we have some exceptions to that rule, but in most cases, we want to see that the rent covers the mortgage. Great loan for investors. Another thing that I love about that loan is that you can close it in an LLC. So this is truly a commercial setup that gives you long-term debt. So unlike most commercial loans that are out there that offer you short-term financing, 3 or 5 year balloon where you have to pay that balance off. These loans actually come with a 30-year fix, interest only options, sometimes out to 40 years. And investors love that because they don't have to guess what the next 3 years or 5 years are going to look like. They've got a fixed rate on there for the next 30 or potentially 40 years.
And it's almost as simple as just having the appraisal done on the property to make sure the value's there. But more importantly, what's the market rent? What's it going to get? So, you don't necessarily need to have leases already in place or any type of history of renting that property specifically. It's more based off of what the market value is, which helps too.
So we've been doing a lot of those. And the cool part about those loans is we can go all the way up to 20 units, sometimes exceptions to go higher. But we're most commonly using those on 1 to 4. But, I've got one going right now. It was a 6-unit.
Which traditionally in the past we could never do before.
We couldn't do it in the past. It's a 6-unit though, and it's priced at $375. no bank would touch it.
Yeah.
The loan amount was too small. It was a 6-unit. There were like 3 exceptions that I got on it, and voila, here we are. Like, he's closing in like 2 days.
Nice.
And so, yeah, was it? And again, this isn't like a hard money loan. The rate on this is like in the low 7s, where everyone else's rates right now are in the high 6s. So it's not that big of a change as far as what you would get on any normal loan out there. So again, guys, we're giving you some nuggets out there that are really good to use in today's market, and it gives you flexibility on, we underwrite that ahead of time too. Everything that we do is pre-underwritten because you have to have like that firm,
no surprises
and that firm approval in your hands when you're out there shopping. Anything you want to add to the cash flow loans?
I mean, I think you've hit it on the head. I think really it's the sense of ease as well for the investor. And again, if you have a sophisticated investor that has multiple properties, this is turnkey and just makes things so much
And
easier.
just so you know, you can't on a Fannie or Freddie loan on an investment property, you might get a little bit better terms, a little bit, but you can't close in an LLC. And so that's, I think, one of the key components that my investors love is that we can close it directly in that LLC for them.
Agreed. It's huge.
So talk to me a little bit, because Tom, I think you just cleared one up recently, but talk to us a little bit about our next one we wanted to cover today, the bridge loans.
Well, I think one of my favorite loans, and you mentioned, is the bridge loan. And there's a couple different components that go into it, but I don't know how many times we've been working with clients where they've got all this equity tied up in their current property. But in this market, yes, you can sell your property like that, but where are you going to go? People want to purchase before buying, but they've got all the equity and what they're going to use from a down payment perspective tied up in their house. And so this product, and this allows people to take that equity out of their home, use it for the down payment on their new property so they can purchase the new place and then move and then sell, as opposed to in the past, it's always been sell and then basically move.
Which is hard to do right now because you sell and you don't have nowhere to go. So
right, exactly. You could be out for months because of how difficult the market is. And so this gives you that opportunity to make it a little bit more streamlined, to make it easier. And yes, they have had bridge loans in the past. These bridge loans, you needed to qualify, however, for your current mortgage, the bridge loan, as well as a new place. There are some programs in there that, depending on situations, and again, we can fit it for you, that we've got access to, that they won't count those properties against you, your previous property. It's only going to be the new one that you're going to be taking out. And so it really enables you to take advantage of the market and be more competitive. Yeah. And I don't know how many times we've had shows on here talking about how you can be competitive and how you can get that leg up. Well, the two big things we talk about is non-contingent offers, meaning you don't have to sell your property, and larger down payments on the new property. So giving you the opportunity to take out a bridge loan and not have to count all of those against you allows the fact to be much more competitive.
Yeah, I love that. And look, guys, at least in Chicago, I don't know about other markets, but you are not going to win anything with a contingency. No. So
not a home sale contingency.
You either have to do a bridge loan. There's other bridges out there we can look at, like home equities and things of that nature, but you have to have that clean, non-contingent offer to even have a shot here in the city in most cases.
Absolutely.
I don't think I've seen a contingency on something as far as a home sale contingency in 4 or 5 years, at least. I mean,
definitely not the last 2.
Yeah, at least. I mean, so I want to talk about another one. That's great. I think the bridge loans are great. I want to talk about another one that is interesting. And I've worked at other companies before, and we've had access to like asset depletions and things of that nature. We've got a really cool product out there right now that we're using for high cash net worth borrowers that don't want to, like, I don't want to liquidate anything in this market right now.
No.
I looked at one of my stocks this morning and it was up 5,700%.
Wow.
It was NVIDIA. So we all know what that's doing right now.
Yeah.
I don't want to liquidate any of that stuff if I don't have to. So at the end of the day, we have a really cool loan where we'll look at strictly your assets. So I'll give you a story. I got a client right now. He's buying a place for about $700,000. Okay.
And not to interrupt, but you said high net worth. Let me clarify. You don't have to be
high net worth. But in cases where you do have assets, yes. As far as liquid assets, he was able to, this is what happened with him. He had a $700,000 purchase. he was putting 20% down. So that put his loan amount at 560, and he had a little over $1 million left over in the bank or in investments. We were able to give him a loan just based off of having enough to cover his mortgage.
I love that. Like, I don't know how many times
I don't need any tax returns.
No.
No, nothing. Just his asset statement.
In the past, I've had borrowers come to me and say, I'm looking to purchase this. And we look at the income, we're like, we can't afford it based off of the traditional box guidelines of a conforming loan. And they're like, but I have $1 million in the bank. I have $2 million in the bank. And in the past, it was always like, sorry, like you can't do anything because you don't have the income.
And they're like, are you kidding me?
Right.
I've got $2 million in the bank, but you guys can't give me a loan because I don't show any income and I'm retired.
But I could pay cash for this if I wanted, but I choose not to, and so I can't get the loan. You can.
Yeah. Great loan. That saved my client. It's the first thing he said to me. I need to work with somebody that understands asset-based loans. And I'm like, well, you found the right guy.
Yeah.
So keep that in mind out there. Just because you don't maybe show a lot of income, maybe you have good assets. Maybe you have access to 401k. There's ways we can look at your overall picture. And again, it comes down to what Tom said earlier. It's the customized mortgage. It's not what you fit into the box best. It's what fits you the best. And so we look at all that picture for you. And again, that loan, great rate. It wasn't like it was a much higher rate. He was happy with it. I was happy with it. The realtor was happy with it, and it was a win-win.
Talk about specialized loans. I mean, that kind of leads us right into that next one where, I mean, you just did one yourself with regards to doctors and professions. And again, everyone's always talked about a doctor loan, but I don't know if anyone has really understands them.
And I think the common thought when it comes to doctor loans, these are loans for physicians, optometrists, anybody in the medical field that has a doctor behind their name. In most cases, it's a practicing physician, right? So, or dentist, whatever the case may be. There's a whole plethora of fields that qualify for this, but everyone's always looked at the big banks as a leader. And I used to work at a big bank, and it was the number one loan that I used to do. And yes, are they competitive? They are, but you'll find sometimes that they're very strict on the guidelines. If you don't fit that box perfectly, you can have issues. And we're in a heavy condo market, and they'll tell you at the big banks that they're very strict on everything and anything on the condo requirements. So we've actually got some great doctor loan products, better than we've ever had over at Cross Country. But we've got some great products over here. I've got one right now, and we were actually beating the big bank with our doctor loan. So it's a great loan. You can put up to zero. You can do 0% down, no mortgage insurance. A lot of physicians we find, want to keep their money in their practice. They don't want to put a big hefty down payment down.
Well, they've got all this debt too.
They got all this debt, and it doesn't fit every physician. Look, if you're putting down a big down payment, there's better options out there for you. But the nice part about it is, like, if you're in your residency, you don't have to count the student loan debt against them, which will weigh you down big time when you've got $200,000-$300,000 of student
just
loan
waiting
debt.
For that first.
You're in your residency making $65,000 a year, so great product for residents and attending physicians when they get out of the residency. So again, these are all exploratory, but the no money down doctor loan is a great product. I agree. I love that out there, right? So good stuff. I think the last one that I wanted to really touch on.
It's kind of a combo to a certain extent.
It is kind of a combo. Like, everybody's like, I think their parents beat it into their heads that you should not pay mortgage insurance. That doctor loan is great because it doesn't have mortgage insurance on it, right? We have other options though, and we offer some good loans. Talk about the 3% down, and
Well, and again, we've talked in the past. We've had a show on myths. One of those myths was putting 20% down to avoid private mortgage insurance, or having even to put 20% down. Period. And first-time home buyers, just even with your typical conventional conforming, you can get as little as 3% down. And we've got a special product as well where you can avoid private mortgage insurance with 15% down.
Yeah.
So
and 3%.
Depending on the situation.
3% first-time home buyers. There's a 3% down no MI option that we have right now, which is unbelievable if you qualify for it. So, that whole myth around 20%, this is a world we live in today, especially with the markets raging like they are, where the leverage can make more sense. And I think one of the things I love about you and myself is that, not only are we talking to our clients, we're talking to their financial advisors. We're making sure that does 20% really make sense for them, or can you do better for them in the market right now? This 3% down or 15% down options that we have with no mortgage insurance tied to it, like, is that a better option for them? And I think people get fixated on, I want to do it because I don't want to pay PMI, but what we focus on is what does that payment comfortable look at for you? And if 3% down makes sense, then run with it, because in most cases it only can happen maybe once or twice in your life.
What's crazy, especially with AI now, so we ran a program and essentially we're comparing 5% down and paying private mortgage insurance with that specific amount that was going to cost them versus going 20% down. And at the end of the term, which was 20 years that we ran it through, which one of the reasons I don't even like putting more down is because you're not even going to live in the property for 20 years. But side note, at the end, you saved about $40,000 in private mortgage insurance and interest, or basically over the course.
Yeah.
But that 15% that you didn't put down was over $500,000 if it was based off of a 7% return on your investment.
In the markets, yeah.
So save $50,000 or make $500.
Yeah.
Weigh those two things out. It's crazy when you start looking at the actual numbers. And I have a very strong belief, especially with first-time home buyers. Our ultimate goal is to someday have the opportunity to retire. And the way you're going to do that is to create your foundation of assets so they can compound upon each other and continue to build and continue to grow to create wealth. One of the biggest misnomers, putting 20% down on your very first purchase, takes that 15% or even 17% you didn't have to save $150, when in fact that 15%, which could be $60,000, even $100,000, putting that as your foundation in this market, gaining 10% or more every year, like the amount of money and wealth that you're losing as a result is huge.
It's exactly why we're called More Than a Mortgage. Yeah. It's one of the reasons we put this whole podcast together, is because we like to talk about that.
Yeah.
Like building wealth, helping people grow their investment portfolios, helping people grow their wealth by appreciation in their properties. It's exactly why we put this show together, because it really is more than just the rate. It's more than just the am I paying PMI or am I not? It's how do I build wealth and do it the right way? And so I think everything we talked about today, I think people should walk away from the show today and say, you know what? I feel better about the options available to me. I know that if my lender tells me no, I need to go make a couple more phone calls.
Just to make sure.
I mean, sometimes it is the end of the road and you don't qualify, but in most cases.
But do you have a plan in place so you can?
That's the key. What is the plan? I talked to a lady the other day and I'm like, by September, October, we'll be there for the bank statement loan. You're not quite there yet. But there's always a way to look at things or put a plan in place, right? So I just want to say thank you to everyone who's listened to us for the past year, and hopefully at the end of the day, we provide you with one or two nuggets on each of our episodes that can help your businesses, help your lives. That's why we've got so much on our brains all the time that we don't get out. And this is a great spot for us to do it. So
I agree. It's a great discussion, lots of topics. And again, I think both of us have the mentality that to help educate and help people with information so they can make the best informed decisions. So yeah. It's been a fun year.
Yeah. And definitely follow us on YouTube, Spotify, Instagram. We're on all the fun little social media platforms right now, but
see what year 2 has in store.
And for those of you that didn't catch at the beginning, non-QM stands for non-qualified mortgage. So it's a box outside of the conventional world. But I'm Mike Black.
And I'm Tom Merritt.
And we are
More than a mortgage.